Hi there, my name is Jason Ayers, Director of Business Development with the Croft Financial Group and a member of the Investment Review Committee. On behalf of the committee, thank you for taking the time to watch our Portfolio Manager's Brief for May 2019. While despite headlines suggesting a slowing global economy and an uncertain geopolitical backdrop, major stock market indices in both Canada and the United States continued to climb through the month of April, stretching into all-time highs much like an elastic band. Fear of missing out may be part of this rally, but a deeper dive into the key drivers suggests that the accommodative monetary policy of the central banks has been the major tailwind. The reason is simple. When money is cheap, assets such as stocks become expensive as companies borrow money to buy back their shares, which boosts their share price. Low rates also motivate companies to borrow money to hire more people and invest in growing their business, which supports the economy. While there may be room for further upside, company share prices are getting expensive compared to their future growth prospects. We also must not lose sight of the recent yield curve inversions that took place. With the recent yield curve inversion in the bond markets, which historically precedes a recession, unsettled U.S. trade relations with China, and an uncertain outlook for global growth, our expectation is that this impressive recovery of the stock market is likely to slow and snap back, much like a stretched elastic band. Year to date, our investor portfolios have mostly rallied with the major indices, but more moderately as we have maintained a more defensive stance. In general, we have underweighted the traditional high flyers, holding fewer tech-related companies, which have been leading the current trend to the upside, and instead focused on finding undervalued companies with stable business models and recurring revenue streams that historically do well in slowing economies and uncertain economic conditions. I'll add that this is like finding a needle in a haystack at current market highs. Our more conservative income-focused portfolios continue to overweight bonds and fixed income investments while owning stocks that pay consistent dividends and exhibit the stability mentioned earlier. Option writing also continues to be an important strategy on a portion of the portfolio, which helps generate income beyond the traditional approach and reduces the impact of some of the day-to-day price swings. Within many of our more growth-oriented portfolios, we continue to take advantage of an inexpensive option market to help offset the risk of another pullback. In simple terms, certain options and other stock insurance have been relatively cheap, and we have been able to take advantage of these tactics, which, much like any other insurance, comes at a cost to the bottom line performance. However, we believe it's a price currently worth paying to offset the risk of an uncertain global market outlook. Our more growth-oriented portfolios also continue to trim more volatile, higher-performing assets and thus hold higher levels of cash. We feel this serves our investors well, both as part of our hedging strategy and by allowing us to take advantage of a drop in the market as the shares and companies on our watch list sell down to more attractive entry points. In closing, investing is a marathon, not a sprint, and there are times to deploy capital to take advantage of opportunities, and there are times to be defensive. While the fourth quarter of 2018 took many investors on a detour, we appear to be back on track for 2019. However, we continue to expect there to be bumps along the way, as there always have been. We have managed through these conditions before. We will continue to maintain our defensive stance and act when market conditions are more attractive to adding additional risk, and once again, as opportunities present themselves.